Good day. This is the first in a 7-part series on analyzing the working capital and the current asset management processes of a business. And the first session we will deal with introduction on working capital, and then also what are the objectives of working capital management. A company like Ford, for instance, are very cognizant of the management of their working capital, and if you compare them to the industry, you'll see in terms of Tesla fairly low at 1.25, General Motors at 1.8, and Ford at 2.33, which is in the top part of the industry. And that means they are managing their working capital very well, and also they have certain techniques and policies in place which serves them well. What are these things that needs to be managed? We will investigate them now. Okay, working capital, that's the sources of funding that funds our operations. So those are current assets, and the current assets are inventories, trade receivables, other receivables, and also marketable securities. So liquid assets in the short term. Net working capital, on the contrary, is then working capital minus current liabilities, or current assets minus current liabilities. So just see the difference. Working capital, only current assets. Net working capital, current assets minus current liabilities. When the number is positive, it means the company is in a position to fund its operations. On the negative, it will have difficulties funding the operations and will run risks. And there should be a balance between the risk and the return. But these management of working capital is driven by the working capital policies of the company, which they should implement and adhere to. What are the objectives of working capital management? There are two parts to the same coin, and on the first part, there needs to be sufficient working capital resources to maintain the current operations and to be able to grow the company and grow the operations. Therefore, buying more stock and being able to fund the customers until they pay. So therefore, working capital required. And on the other side of the same coin, working capital investment should be kept to a minimum, because that impacts the profitability of a company, and the higher the levels of working capital invested, the lower the profitability. Okay, so two areas of risk that needs to be managed. First one, overcapitalization. So that's a risk of investing too much money into inventory, accounts receivable, etc. And they needs to be managed properly so that those investments are as low as possible, but with the understanding that the operation is still able to continue. But overcapitalization means there's just too much money stuck in the working capital, specifically in the inventory and the accounts receivable. So what are the symptoms of something like this, of overcapitalization? Long accounts receivable collection periods, low inventory turnover rates, and high liquidity ratios. Overtrading, on the other side, is when a company grows too fast, too quickly for the resources available, especially the short-term resources. So therefore, the company cannot fund it anymore, and there are a number of symptoms, and those are increased inventory holdings, increase in accounts receivable periods, increase in accounts payable days, because we are not collecting the money from the customers, so we cannot pay our suppliers. Overdraft facilities are maxed out, cash balances are all depleted, and low and falling liquidity ratios. So this leads to relationships with the suppliers being jeopardized because they're not being paid on time, and there are continuously issues with payments to suppliers. Similar with bankers, accounts are maxed out and continuous requests for extending overdraft facilities, etc. And then the relationships with customers are jeopardized because stock cannot be obtained from the suppliers, and therefore no stock available for customers, and that leads to loss of customers. So working capital management can be managed properly or effectively if there's a clear policy and the policy is followed. If liquidity ratios are managed continuously and reviewed continuously, and the drivers behind those are understood and managed. Also through cash flow forecasting, when cash flows are understood, then the informed decisions can be taken. And the last one is the operating cycle, and the operating cycle will be discussed in the next slide. So the operating cycle is the duration from when inventory is received through the process of selling the inventory to eventually receiving the cash from and the payments from the customers. So in the green area you can see the inventory period, then it's sold to the customer, and the customer then needs to pay, and that's the accounts receivable period. On the bottom section there's an accounts payable period, and you'll see that it does not coincide with the inventory period. Why? Because the accounts payable period is a set period negotiated with the suppliers, and they need to be paid, let's say, in 30 days, while the inventory might still be in stock to be sold, and only sold a few days later. There are a few calculations that we can do. The inventory days is the average inventory, and as soon as you see average, it's opening plus closing divided by 2. So the inventory days is the average inventory divided by cost of sales multiplied by 365, resulting in a number of days. The accounts receivable days, similar, average accounts receivable divided by credit sales multiplied by 365 gives us a number of days, and accounts payment days is the average accounts payable divided by the credit purchases multiplied by 365. And the longer the operating cycle, the more risky it is for the business, because the money is stuck into the working capital. So this wants to be managed to be as short as possible, and therefore inventory periods and accounts receivable periods needs to be reduced as far as possible. So that brings us to the end of the session on the working capital management definitions and the objectives. The next session we will focus on the cash conversion cycle.